How badly do you want to declare victory at this point?
Not particularly badly at all. I mean, look, the trends are moving in the right direction in some very important variables. We always, as you know, Kailey, we're looking at this from the perspective of households at the kitchen table. We know that the progress is important, but we know that we have more work to do. In this regard, by the way, I think one of the somewhat underappreciated numbers coming out of the PCE report today is strong consumer spending in July, 0.4% for the month, real. Okay, inflation adjusted, just below 3% year over year. And that tells you that lower gas prices, which are about 50 cents per gallon, lower than they were a year ago, strong job market generating real wage gains. Those are creating forward momentum in the job market. And we're seeing that in consumer spending, easing inflation, rising real pay.
Well, Jared, I'm glad you raised gas prices because on the early edition of Balance of Power today, I spoke with Patrick DeHaan, who's Gas Buddy's head of petroleum analysis, and asked him about the trend of gas prices we're seeing currently and where he thinks they could go in the coming months. This is what he told me.
We certainly could see more and more gas prices below the $3 a gallon mark. Gas Buddy data showing 8 states where average gas prices are below $3 a gallon for Labor Day. That number could double or even triple by the time we get to Halloween or into Thanksgiving. Some caveats, you could say the typical caveats apply. Hurricane season has been relatively quiet, but we are in the prime. There are a couple areas of interest that the National Hurricane Center is monitoring. And of course, the other wild card, the Middle East.
How worried, Mr. Chairman, are you about those caveats? Or do you actually think we could be looking at a sub-3 figure on the average pump price come Election Day?
Patrick knows those numbers better than almost anyone, and he's actually been, I think, quite a reliable forecaster with the caveats, frankly, the very ones he offered, that it's just very hard to tell the wiggles and waggles in that particular price. What I can tell you for sure is that drivers this Labor Day are going to be looking at the lowest price in the pump in about 3 years. If you look at TSA numbers, so we're not just talking about driving, we're talking about flying, what we see are a lot of people going a lot of places. Now, I understand that there are still real anxieties out there around the level of the price. Certainly, VP Harris, President Biden reference that every time they talk about it, particularly in reference to their cost-cutting agenda, housing, childcare, prescription drug, junk fees. That agenda remains as aggressive as ever. But I think it's really important to see in today's report rising real incomes. We at CEA, we did a blog on this today. We have real incomes up about 5% since the president took office. And this is important because one of the things we hear a lot is people just talking about the price side of the equation without looking at the fact that wages and incomes have been beating prices. And that gas story is part, I think, of that favorable story from the consumer's perspective.
Well, as you raise incomes, Jared, we'll, of course, get more wage data, more employment data next Friday, a week from today, when the next jobs report is due. Considering the softness we saw in the last reading, is there a low bar figure you're looking to clear? What kind of figures would concern you, be it on non-farm payrolls or on the unemployment rate?
I think what we're looking for there is to try to see how sort of off trend July was relative to the August number that we'll get on September 6th. We saw an unemployment rate tick up 0.2, a cooler than expected report. Basically, what you want to see is how this report does relative to expectations. Now, that's a report that's also very hard to predict, as you well know. It's a high frequency, noisy report. However, one indicator we do have is uninsurance claims over the month of August, and they've looked quite good. If you look at yesterday's numbers or the week before, they've really been about where they were a year ago. So I would think that the expectations when they start rolling in will be for months that look more like June than July. But if either way, I hope we're talking about it around this time a week from now.
Well, I share that hope that you'll be back with us on Bloomberg TV and radio, Jared. Of course, that's going to be pretty important data to get before the Fed's decision that's coming up in a few weeks' time. I'm not going to ask you if you think they will cut or of what size. I will tell you the market is expecting interest rates to be lowered, and they think they may be lowered to the tune of 100 basis points by year end. Where would that leave the U.S. economy come January when a new president, whoever that may be, will be taking office if we see 100 basis points of easing?
Well, okay. So the way you teed up the question, I don't have to weigh in on what the Fed's going to do. I'm just going to answer. I'm going to answer
Yes.
your query there. And look, I mean, I think that this would be very consistent with some important developments that tend to occur when interest rates go down. And the first thing I think of is the mortgage market. Okay. So look, we've had mortgage rates on the 30-year fixed rate mortgage that were, above 7%. Last I looked, they were 6.4. A lot of that's pricing in of the kind of dynamics you just discussed. But one of the things that we're looking for out there is for a lock-in effect to get unlocked. That is, people who want to move but have been hesitant to do so because they're locked into a lower rate than is available on the open market. As that mortgage rate starts coming down, that lock-in effect unlocks. Now, I've talked to experts in the field. I said, what's the magic number? What's the key that unlocks that effect? And some say less than 6%. Some say less than 5%. I think the right answer is who knows, but it's moving in the right direction. And especially one of the things we see, of course, is that these price moves on the mortgage rates get priced in before the central bank makes their cuts. So let's watch that and see how that unfolds, given the data flow that coming in.
And finally, Mr. Chairman, while we're on the subject of housing, that is obviously an area in which Kamala Harris has specifically targeted with the economic proposal she would like to pursue if she does indeed win in November, including, for example, $25,000 down payment assistance to first-time home buyers. I spoke with Betsy Stevenson of the University of Michigan about that plan yesterday and whether or not it was fiscally responsible. This is what she told me.
My hope is she's got a great proposal, $25,000 for first-time home buyers is a great idea. Let's just hope it's balanced with, maybe reducing the handouts we're giving to wealthier families with big houses.
Mr. Chairman, it raises the question about the pay-fors. Considering how hard this White House in particular has tried to fight the battle against inflation, same goes, of course, for the Federal Reserve. Are you worried that some of these policies being put forward by, frankly, both presidential candidates could potentially be inflationary in nature if they are not adequately offset?
Well, I think the right place to start with that is to really drill down a bit in something that you and Betsy weren't talking about, which I view as the key part of VP Harris's and President Biden as well, in fact, because there's similarities there of their housing plan, which is to increase the supply of affordable housing. We have a 10-year shortfall in the supply of affordable housing. And if you look at Harris's plans there, whether it's expanding the low-income housing tax credit, which is a tried and true measure to build more affordable multifamily housing, or some very important subsidies on the building side to help make pencil out deals in the single family affordable space, that adds more supply. And that, of course, is disinflationary in a sector that's really suffered a long-term shortage. So I think whenever we're talking about adding supply where it's needed, and boy, is it needed there, she's talking about 3 million units, that would make a huge difference. I think we're really talking about more of a disinflationary impulse than the other way.